Cryptocurrency has been garnishing a ton of media attention over the last few months and really over the last few years, and that's primarily because of the astronomical growth and value that cryptocurrencies have been experiencing over the last few years. For Bitcoin, which is the most widely used and recognized cryptocurrency, there is a key event that is rapidly approaching called the halving. Now, crypto halving refers to when rewards for Bitcoin mining are cut in half. The last halving that occurred was in 2020, and the next one is expected to occur in April of 2024. So in this video, we're going to talk about all of the 2024 crypto halving and what it could potentially mean for investors. But let's first understand what cryptocurrency is. Cryptocurrency, or crypto for short, is digital money that is not issued or managed by any central authority. Instead, it is created through a network of computers. All crypto ownership and transfer information is maintained on a distributed digital ledger protected by strong cryptography and is referred to as the blockchain. In this distributed system, ledgers are maintained by miners or parties that validate transactions. In 2009, the first cryptocurrency called Bitcoin was released. Today, there are over 25,000 forms of cryptocurrencies, and despite its name, crypto is actually not considered a traditional currency. In fact, the IRS in 2014 deemed that it should be considered property for tax purposes. However, it is perceived to have several benefits over traditional currencies. These benefits are primarily considered to be privacy, in which no personal information is exchanged when purchases are made with crypto, and no central authority oversees the transactions or interferes, and of course, global use, because cryptocurrencies are used globally, so there's really no foreign exchange rate risk. Now, I've mentioned the word miners before, and for some context, mining is the process of validating crypto transactions and creating new crypto. In the case of Bitcoin, a block is a file that contains 1 megabyte of Bitcoin transaction records. Miners compete by using heavy computing power to solve the complex mathematical problems and validate that block. In exchange for completing a block, they receive a certain amount of Bitcoin. When Bitcoin was first introduced, miners were paid 50 Bitcoin per block, which is an astronomical amount of money in today's Bitcoin value. Now, part of the protocol of Bitcoin includes pre-programmed halving events, at which the amount of Bitcoin paid for each new block is decreased in half. A halving occurs every 210,000 blocks mined, and historically this has equated to about every 4 years. Halving serves several purposes. For one, it controls the supply by reducing the reward for mining and thus the rate at which new coins are created. From an economic standpoint, when the supply of goods decreases while the demand remains constant, the price of such goods tends to rise. Halving reduces the financial incentive to mine Bitcoin, and thus, as a result, the supply declines. Halving events also increase the predictability of the supply of Bitcoin. Eventually, miners are expected to shift away from creating new Bitcoin and instead making money from other transactional fees. After the 2012 halving, the price of Bitcoin increased steadily over the next year. After the 2016 and 2020 crypto halving events, the price increased steadily over the next year and a half, and with each increase followed a slow and steady decline over the subsequent year, followed by a year and a half of a fairly flat price. So as you can see, there are several impacts in prices after a halving event. Now, of course, the crypto market is quite complex and is influenced by a number of factors, so it is really difficult to really isolate price movement and the quantity of a specific impact of the halving on these price movements, but it's safe to say that there's some effect and some consideration should be given. Now, of course, there's a famous saying, while historical performance is not indicative of future results, patterns such as this can help investors make more informed decisions. Crypto markets have been historically a lot more volatile than the stock market, and with every halving event, there typically is some short-term price increases that have, of course, greater return potentials, but also greater loss potentials as well. Investors should be prepared for both upward and downward market fluctuations and consider risk management strategies to protect their portfolios. Another thing to consider is diversification. Part of any good form of risk management strategies includes diversifying investments. Investors should align their overall portfolios with their risk tolerance. This might include matching the increased volatility of crypto with perhaps more secure investments to help mitigate potential losses. Now, if you'd like to know how cryptocurrencies are taxed, you can go ahead and watch this video that we've laid out for you up here. And if you'd like to learn more about My.CPA and see how we can help your business and your personal situation, whatever the case may be, you can give us a call at this number here or reach out to our email over here. Guys, thank you so much. And as always, take care.